folks, hope you're all well and hope the market's been treating you kind since we last spoke in September 2023. It's been a while since I put out the video on the 4-year cycle and potential left translated cycle risks for Bitcoin, but there's been a few comments in the last few months on the video asking for an update and to go back and have a look at where we are just now against what we spoke about then in terms of the risks and what we should be looking out for. And with the halving coming up this month in April, it makes sense to have a look back and see kind of where we are, what the risks are at the moment, where we might be based on the potential outcomes we talked about at the time, and if there's any new or emerging risks that we should be looking at. And in terms of the videos themselves, it's been a while since I put a video out because I've been working on something else pretty much every spare hour over the last year. It's actually longer than a year it's taken me to put this together. But I've been writing a book on personal finance, financial planning, social financial norms, and how we can break those social financial norms for the betterment of ourselves. So it's something I'm quite proud of being able to put together. It's taken a long time, but it's now available on Amazon for both paperback and ebook. And if you're a member of Kindle Unlimited, it's available on Kindle Unlimited at the moment as well. So if that's something of interest, as it talks about the whole kind of gambit of personal finance, not just the trading and technical analysis side of it, although it is mentioned within there. It talks about investing and building investment portfolios. And there's a financial plan template downloadable from the website that helps people put that together. So if it's something you might be interested in, then feel free to have a look. But really, I'm just letting you know that that's the reason I've not been putting these videos together as frequently as I might have been, because I've been working on that for so long. So, looking back then, the chart on the screen is the chart from the actual video in September last year. So as a reminder, the red time cycles are the bottom to bottom cycle timelines or notional cycle timelines, and then the green time cycles on the bottom are the tops to tops. So the green vertical lines then represent the notional tops, and the red vertical lines the notional bottoms of those cycles. The purple lines indicate the midpoint or notional midpoint of those cycles, and the orange lines are the halvings that happened in the previous cycles. The projected halving, obviously, for April this year, I've still got that as the 26th of April, but that may move a little bit. It may have moved already, to be fair. The halving dates themselves have never been hugely important dates for me in terms of the left translated versus right translated discussion, or even the all-time high pre or post discussion. I think I discussed in the last video that in each halving cycle, or each 4-year cycle, the halvings had moved further to the left, and you can see that quite clearly in this chart, that it starts on the right, moves to the left, moves a bit further to the left, and this one is going to move even further to the left still. So the kind of risk materialization point, or where the risk became higher for me that we discussed in that video, was if we breached the all-time high prior to the midpoint of the cycle. So again, if you look at this chart, you can see in all previous cycles, the all-time high, or the purple vertical line, it was never breached by price on the left of the cycle. Price always remained below it on the left of the cycle. So a lot of people attribute that to the halving, but for me it was always the midpoint of the cycle. It came close in the last cycle, but it never quite got there, and it was on the right that it eventually broke the high. So that was the kind of main risk point, or the main area that I'd be looking. If we get that all-time high prior to the midpoint, the risk of a left translated cycle increases. Doesn't make it for sure, it just increases the risk of it. So if we take this chart and compare it to where we are at the moment, you can see we did break the all-time high prior to both the halving and the midpoint of the cycle, which for me I've got as kind of November this year. I know others have looked at it and it's slightly different, maybe October, September, but if you consider this notional midpoint of somewhere between September and November, whichever one you prefer, the Earth was taken before it. So that increases the risk in terms of the left translated cycle, because we now have a high on the left. The logic behind that is, obviously, if we had not got a high or broken the all-time high before the midpoint, it couldn't have been a left translated cycle, because you wouldn't get a high unless the high was going to be lower than the previous high, and their assumption or base assumption is that the return will be higher than the previous cycle. So the fact we've broken the high prior to the midpoint, it increases that risk of left translated cycle. And if you look at the orange ghost feed in there, which is the Nasdaq.com bubble, you can see it's gone kind of fairly similarly so far, but without that blow off top element of it. So that Nasdaq cycle is not supposed to be trying to represent a potential high for Bitcoin. It's just representing the actual price movement of Nasdaq during that time. So if we were to see a left translated with a similar blow off top that we saw within Nasdaq, I would expect that Bitcoin price to go higher than the top of that orange high that we've just passed, basically. So yeah, so the chart has progressed fairly well. We've got that all-time high that's been broken now. In terms of cycles, there's a lot of conversation around what was the actual high of the previous cycle. So if you look at things like the pi cycle top indicator, which I don't use, but I do kind of pay attention to it because it's been fairly accurate. It had the high as the first top in April, so this first top here rather than the second one. I tend to agree from a cycle perspective and an Elliott perspective, which we'll look at in a second, that probably was the high of the Elliott impulse, and what we've seen since then is a flat expanded fourth wave, missing a fifth wave of the overall impulse. But from a cycle perspective, what we're looking at is the all-time high and when it was broken. So although I'm counting the second high as being the all-time high, that's just because it was literally the all-time high, as in the highest price that had ever reached, and that was broken prior to the midpoint. I think the cycle high was likely that first high that we can see marked on screen here. So we'll go into that in a bit more detail in a second, but that's just a refresher on the chart, what we're looking at, and just to highlight that the major risk that I spoke about then has materialised, and let's have a look at see how that impacts potential paths from here. So another quick little refresher of what I thought might be the primary when we spoke about this in September, and it's this on screen from the video itself. So I was looking at kind of 1, 2, 3, 4 and the completion of a fifth Elliott wave there, which would have been the internal of a wave 1, a larger wave 1 for a new cycle starting. Now this one was predicated on the size of the wave 1. So the way I do Elliott wave projections, all of the future projections are based on the size of the wave 1 and the strength of the wave 1 internal of the next fractal. So for this to be what I would consider a legitimate wave 1, looking at what would then be wave 3 and wave 5 potential targets, that sort of height there at around the 42 to 47 or 42 to 49 if you like, area between the 272 and the 2618 was the area that I would generally look at for a 1, and that's just based on the projections then for a 3 and a 5 after that. If the wave 1 goes any higher than that, then the wave 3 and the wave 5 projections become a little bit outlandish from a cycle perspective, and considering the time within a standard 4-year cycle, they just project too high for my particular taste. I'm not going to give you the number, but just they are outlandish in terms of those numbers. So this was my primary then, and what I was looking at was the expectation that we had seen a 1, 2, 3, 4. We were in a flat 4 at the time, and we'd see a fifth wave complete to give us the 1, and then a potential wave 2 retrace of the larger set to give us the start of the third. Now we obviously didn't get that, because what would be the fifth on the screen, as you can see it just now, it went much further than that, to essentially where we are at the moment, around about the 72, 73 type area. That takes us to those outlandish figures for future wave 3 and wave 5, which in my mind makes it less probable. I prefer to look at what's most likely and less likely with invalidations and validations than look at it and say that number is really big, I like that number, so I'm going to go with that number. So for me, the price action we've seen since this point makes this primary thesis less likely than more likely, and the price action we've seen since this point makes what I had raised at that point in terms of the tail risk more likely than less likely. Again, nothing's guaranteed, it just changes the probability of each of the potential outcomes that I was looking at. So let's have a quick look then at what those other risks were at the time, and have a look at that in the context of the price action as it is right now. And that looks like this. So this includes both the higher level or macro Elliott set that I spoke about a few minutes ago, in terms of the top of the previous cycle being a 3, and then us seeing a flat expanded fourth within that, and then what the start of a fifth might look like to finish that set, and potential ranges for that target. So you can see in this one it's got a smaller 1 on the initial move off the bottom in this cycle, with a 2, 3, 4, 5, and then potential 2, 3, 4, 5 after that measures somewhere between 74.9 and 95.2 in terms of the standard ranges that I would use, not including any overextension for a blow off top. So there's a higher number than this. There's a couple of higher numbers actually, one around about the kind of 120 to 150 type area, and one up around 249 that would be blow off top type scenarios. But from a structural perspective, this was the risk that I was looking at that point in September, and this is the one that I think is becoming more likely, certainly in my mind, for where we are just now in terms of the cycle. And it's slightly different in terms of the left translated versus right translated, because this could still happen right translated. There's no reason that it couldn't go further than that, and there are potential additional risks that I would add based on this one and looking back at previous cycles. But for now, this count from an Elliott perspective and the structure that it's shown, if we look at it in the context of the current price action, which you can see here, it's followed fairly well. So this 1, 2, 3, 4, 5 is the one we looked at a second ago. So smaller 1, impulsive 3, which is, the 3s are normally the larger. You've got again a little flat expanded 4 in there, and the Bitcoin really does like the flat variations in terms of correctors from an Elliott perspective. A completed fifth, and then a flat 2. So the 2 didn't come down as far as I was thinking it would, but still structurally more than enough for that to be a legitimate 2, or certainly one that you couldn't invalidate. And then an impulsive 3. So the 3s are a little bit higher. 2 didn't go quite as deep, but from a structure perspective, this looks like a larger 1, 2, 3 just completed, potential fourth that's happening just now, which is again very shallow. There's an alternate count. I could make a case for this going potentially a little bit higher as a 3 before it comes back into the 4, but the point remains that it still looks like a 3 with a potential fourth to come, and then a fifth. Now the fifth still measures in this range from a low bound of possibilities perspective, or probabilities perspective, but we can still see the kind of higher areas from 120, and the reason for 120 is not on this chart, but 120 to that kind of 146 is the area, and then the higher ones are at about 249, I think, or 290 or 292 actually it's shown at the moment. So that's the kind of areas that I'm looking at for this. But it shows the larger structure from a flat expanded perspective, and if I drop on the schematic for a flat expanded here, you can see it's a 335 correction where the B goes higher than the termination point of the previous impulse, and then we get a move down to a further extension of the A move. So we can see there's a three move wave in there of ABC, and then ABC, and then 1, 2, 3, 4, 5. So the actual count from a structure perspective works. This move here on the FTX move was slightly below what you would say is the maximum of 1.618 of A, but for me it was within the margin of error. It didn't go low enough to invalidate it that you would say it can't possibly be, and I have to pay attention to the structure, where the structure just looks really nice for it, and then coming off the bottom of this structure and what it's put in since then, it looks more like a fifth wave of a cycle in terms of how it's moving than a first wave of a cycle. So this to me is now my primary. This is what I'm looking at. Doesn't mean I'm saying this is definitely what it's going to be, it's just what I'm looking at and trying to look at the risks around this, and that projects low range 75 to 95. I think that is low based on how high the 3's gone, but 75 to 95 I think more likely somewhere between 120 and 146, with a blow off somewhere between 250 and 292 if you're looking at that. So we still see some of the numbers that people are talking about in terms of a cycle, but structurally just a little bit different in terms of how it looks and the risks inherent within that. So it's kind of followed this pattern, which was a risk raised at the time, more than it has what we thought was most likely at the time. And this again fits relatively well with a left translated cycle. We could quite easily, if that's a completed 3 and we're in a 4 at the moment, we could quite easily complete a 5th wave between now in April and November, which is the notional midpoint, and that be the high of the cycle on the left. So nothing certainly has invalidated left translated cycle at this point. If anything, it's become more likely, but we still need to monitor the structure, the price action, and all the other potential risks between now and the end of the cycle, to make the best decisions that we might make between now and then. So quite a lot in that in terms of the catch up. One of the other risks I want to raise at this point, certainly something that's more on my radar just now than it has been previously. I like to look, and this is where the left translated versus right translated conversation started. It's what would see the most amount of people lose, because that's how markets tend to operate. The majority don't win. So what would make the most amount of people lose? I thought previously that was left translated, because people would be thinking it's going to go the same as it's always done in terms of a 4-year cycle. High will be on the right. We'll be calling for super cycles. We'll be calling for all sorts of mania when we get into the second half of the cycle. But it's already peaked on the left, and the smaller number of people have got out, and the larger number of people are held, are caught in the market holding their bags, if you like. I think the idea of a left translated cycle has become more popular. I think there's certainly more people talking about it, to the point where it's difficult to say that would be the scenario that would catch the most people at this point, particularly when price has shown its hand in terms of the all-time high prior to the halving. And again, looking at how I discussed this in the previous video, if you were a market maker and you wanted to try and trap as many people as possible, you would have saved that all-time high until after the halving, because a lot of people certainly were looking at it and saying, if we don't see the high before the halving, it's going to be a standard cycle. So if you saved the high till after the halving, between the halving and the midpoint of the cycle, that would trip more people up than what we've seen, which is a high in advance of the halving and the midpoint. Now, obviously, a lot of that is down to the ETF inflows and the news there, and the buying that happened around about those. Again, that still makes me nervous, because it's very similar in terms of Main Street starting to get involved, similar that we saw at the top of the Nasdaq bubble, and Main Street were the ones left holding the baby, if you like. But I think it becomes less likely to me now that that's the one that's going to be the path of most pain. What I think that could be now is a two-top cycle that does end up being right translated, but there is a high with a significant pullback on the left. So again, this is a tail risk, so I'm not saying that's the most likely. I'm looking at it from the perspective of what could potentially trick the most amount of people into losing the most amount of money and give a return to the least amount of people. And if we look at the previous cycles, just as an example of that, so looking back to 2013, this would be the kind of thing that I'm talking about. So we see the first, now this was a right translated cycle, so it's high, so both of these were on the right. But if, for example, we saw this first high prior to the midpoint with this huge pullback here, anyone who didn't sell in this range of the high would start to get concerned when we see that pullback. So that pullback is from high to the first low wick 81%. If you go to the second low, it's 75%. So that's a significant drawdown. It's a drawdown that's very similar to what we would see in an overall bear market drawdown from a Bitcoin perspective. So that would concern people, and you would expect people, particularly those who are traumatised from the previous cycle, not to hold through that. They would try and sell at some point, and they would be out the market they would be of the opinion it was a left translated cycle, everyone's a genius, they all got out when they should have got out, and then we see this really, really quick second top, which puts in another, from that first low, another 2200%, give or take. Now I'm not saying we're going to get these sorts of percent moves again, but you can see the logic that I'm trying to follow here. Because the left translated cycle narrative has become so commonplace, all the people getting out thinking it's a left translated cycle and thinking they've avoided this huge drawdown potentially then think they're geniuses and get left behind by the market as it goes for its second high. And if I stick the left translated cycle data back on for a second, and I'll let you see the kind of zoomed in Nasdaq, we can see similar in that cycle. So if you look at this price action on Bitcoin here, when it's just kind of grinding, it's very similar to this grinding, and then we see the first parabolic move, which I don't think we've seen yet. The first parabolic move, fairly significant pullback, everyone's a genius, second parabolic move. So that again fits with that kind of narrative that we saw during that Nasdaq cycle. So I think it's worth taking that into consideration, even if we do think between now and November that what we've seen as a left translated cycle. I think we need to manage that risk appropriately, that we see a second peak potentially after that, and we'd have to really look and see what the structure of the market is at the time when we get to that, and see what the sentiment is within the market at the time when we get to that, because that might be how we get the higher number that I had in there from a 292 perspective. So we may see, for example, the 3 extends a little bit. So the second count I said a while back that 3 might not be finished, that 3 becomes overextended. We get that larger pullback for a 4, and then we see the second for a larger move. So I think that now becomes potentially the path of most pain, or max pain, depending on how you want to term it, for most people, because there's so much focus and attention on left translated cycle, rate cuts, recessions, it's an election year, so on and so forth. You can make the narrative however you like to make it. So I think that's the risk to look at, certainly from my perspective. But looking back at the original video, I think this second risk that we raised within that, this is the one that it's tracked most. This is the one that I think is most probable now. Again, left translated versus right translated is not confirmed and won't be confirmed until we roll over. It's all just about managing the risk. And if we look at what could potentially be the path of max pain for most market participants, given the rise in popularity of left translated cycle discussion, it's potentially this, where we see that first high in a reasonable area, somewhere between 120 and 146, significant pullback, everybody calls bear market, everybody's out, everybody's made money, and then it rips again and it catches everybody offside, because again, it'll not just be everybody's made money, there'll be a lot of people shorting into that as well, thinking it's the end of the cycle, because they're expecting then secular bear market and massive lows. It's potentially the short of a Bitcoin lifetime, that one, if it's truly the end of the 16-year cycle. So we end up with an awful lot of people not only out, but an awful lot of people offside to then fuel the rise higher. So just keep that in mind, that the potential for a second top is there. We saw it in the Nasdaq cycle, as you saw on the chart that we had on there. There was that first high, second high. We saw it in a previous Bitcoin cycle, where we saw first high, second high. Very similar sort of idea. So hopefully that makes sense in terms of the risk. I'm going to leave this here in terms of the video. It's a bit longer than I expected it to be, but I'm just getting into the habit of making videos again, having been away for a while. Hopefully it makes sense, hopefully you find it useful, and until next time, take care. Until next time, stay safe. My tea's it. Gotta go.